Welcome back, and joining us on the show now is Kunal Shah. He's head commodities and currencies at Nirmal Bang. Kunal, hi, thank you so much for joining us. And even before I get to the pricing part of it, the street is abuzz with the April 5th deadline when only the commercial players or the hedgers can partake in commodity, rather currency derivatives, and traders would be out of the space. What is the mood right now, and how much of an impact would it have on the volumes?
Yeah, the mood is quite gloomy because of the circular which we saw, and this will only permit the hedgers, the classified hedgers, into this segment. So I think the volumes are expected to dip going forward because predominantly it's a proprietary trader and the retail traders who are accounting for most of the volumes on the domestic bourses. So we are going to see a big drop in the currency derivative volume segment going forward, and the mood is not very great right now, considering that one major revenue driving prospect we are going to see across the all brokers are going to take a hit on this part.
Yeah, well, absolutely. Kunal, so what is the percentage right now between the commercials and the traders?
So I think the rough, we don't have the exact numbers, but the broader, when we did the research, the broader, I think 30–40% of the volume comes from the proprietary traders, around 15 to 20% of the volume comes from the retail traders. And these are the segments which are going to suffer broadly because of this circular going forward. And they may have to, just the positions are just on the, you can close the position, you cannot create the new positions until you are a classified hedger. So it's not a good news.
So, I mean, as you said, with prop and retail put together, would you say that that makes up for nearly 60 to 80% of the overall market volumes?
Yeah. So these are not the official numbers, but this is what the research what we did, and on basis of that, these are the rough numbers what we are getting. So majority of the proprietary traders are going to take a big hit out of this decision.
Kunal, also, I was talking to some of the commodity traders as well. People who are doing international commodities like an energy or gold for that matter, also were trading many of these international currencies because there's a certain hedge mechanism that you have in this area. Do you see a bit of a hit there as well?
Yeah, obviously, because the people who are doing international trading, they will have to, have a currency exposure. They have to hedge their currency. So if they are classified hedgers, I think that they will not have any major impact. But if they are not hedgers and they are doing international trading, which is not legal, then they are definitely going to suffer out of this. So the idea is the same only, that the excessive speculation in the currency, they want to curb down. That may have been the reason. And because of that, this kind of moves have been taken place. But the broader impact on the market of this, because of this step, will be definitely slightly negative from the exchanges point of view, from the brokers point of view. But they must have their own reasons to do this, and they must have foreseen something which is good. That's why they have taken this step.
Sure point that. Kunal, since we have you with us, I also want to sense on the currency itself, because we've seen the dollar index now trade at 105, which is almost a 4.5-month highs as we see it. Well, yes, the data from US has been on the positive side, and that has impacted various currencies, including Japanese yen and euro, Asian currencies, including rupee as well, where we are now almost at 83.20 and past that. How are you looking at the scenario?
I believe that the strength in dollar is going to be very short-lived, and the trend, the directional view from the index is definitely on the downside. So 105, 105.50, I see dollar index peaking out, because the matter of fact is, no matter what is US economic data, no matter what is happening, the rate cuts are inevitable as per our understanding. Because if the rates stay here for the longer, the yields in US will shoot up. And the Federal Reserve cannot afford, because with the rise in yield. So if, for example, there is a 50 bips rise in US bond yield, the interest component, the interest serving component of Federal Reserve goes up by $300 billion. They cannot afford to do that. So if yields are shooting up by 100 pips, then $600 billion an additional amount of interest payment they have to do. And in a scenario where their debt is rising at an alarming pace, they cannot afford to do that. So I think the strength in dollar is going to be short-lived. Markets will at some point, start discounting the rate cuts. We are just waiting for some one or two bad data that are enough for crack in dollar index. Right now, there are no major evidence which indicates that U.S. economy is weakening or there is any bit of weakness. When you printed three and a half, $4 trillion, when $4 trillion are floating around in the ecosystem of the U.S.
Right.
markets, there is not going to be a bearish trend. So, irrespective of what happens, the dollar index is going to weaken. That is our view, and the rates are going to be cut. It's imminent, and it's just a matter of time.
Oh, yes, that's exactly what the street is really waiting for as well. But as you said, on one side, of course, the dollar index is one part of it, but the Indian trade is another one, and the volumes really seem to be dipping because of that, and some concern, of course, coming in for the industry. Kunal, as always, thank you so much for joining in, and that's all the time that we have on Halftime Report. Business Lunch comes up next.